Let's talk about something that's on almost everybody's mind: passive income. You know, the dream of your money making money for you while you're off doing, well, anything else. But how real is that dream? Can you actually make it happen? Let's get into it.
Here's how we're going to break it all down. First, we'll look at the big idea, the dream itself. Then, we're going to get specific and talk about a classic, stock dividends. After that, we'll shine a spotlight on the Canadian market, the TSX, to see this in action, but we'll also look at a potential storm cloud on the horizon for the energy sector. And finally, we'll wrap up with the big question you have to ask yourself: what matters more, yield or growth?
All right, part one, the passive income dream. I mean, the appeal is obvious, right? Who wouldn't want to build something that generates cash flow without you having to clock in every day? So let's just ask it straight up. Can your money actually work for you around the clock? It's a fantastic promise, but, turning that promise into a real functioning plan, well, that's where the real work begins. So what exactly is passive income? Well, the official definition is earnings you get from something you're not actively involved in. These days, that could be anything from crypto staking all the way to the old school classics like owning a rental property.
And that brings us right to our second section, where we're going to zoom in on one of the most tried and true forms of passive income out there: dividends.
For our purposes here, we're going to focus on stock dividends. It's a pretty simple concept, really. A company makes a profit, and it decides to share a piece of that pie directly with its owners, which, if you own the stock, means you. It's a direct cash reward just for being an investor.
And the metric you always hear about is the dividend yield. It sounds complicated, but it's not. It's just a percentage that tells you how much cash you're getting back each year compared to the stock's price. So, if a stock is $100 and it pays you $4 a year in dividends, your yield is 4%. Simple as that. It's your cash-on-cash return.
But here's the catch, and it's a big one. A juicy yield today doesn't mean a thing if the company can't keep paying it. As this quote puts it so well, income only matters if it endures. This is so important. You're looking for sustainability. Can the company afford to pay this dividend year after year? That's what separates a solid income investment from just a risky gamble. Okay, enough theory. Let's move into the real world with Section 3 and put a spotlight on the Toronto Stock Exchange, the TSX, as our case study. Now get ready for this. The S&P/TSX has delivered a total return of 30% year to date. That's a huge number. It just makes you lean in and ask, okay, where is all that performance coming from?
And this chart tells the story perfectly. This is the engine room of the Canadian market. Look at this. Financials, we're talking the big banks, make up almost a third of the whole index. And right behind them, you've got energy and materials. These sectors are the traditional powerhouses for paying out dividends.
And let's put some names to the numbers. You've got the big Canadian banks, which often kick off yields in that 4 to 5% range. They're often the backbone of an income portfolio. Then you have a giant like Enbridge in the energy infrastructure space, which has historically paid out even more, around 6 or 7%. And of course, the energy producers themselves, like Canadian Natural Resources and Suncor, which can also act as a buffer against inflation. But, and there's always a but, isn't there? This brings us to a super important reality check in Section 4. That income is never, ever guaranteed, especially when you're talking about sectors tied to commodities. There are always risks brewing.
Yeah, the global economy is this giant, interconnected web. And right now, one specific pressure point is starting to emerge for Canadian energy companies, and that is the possible return of a whole lot of Venezuelan oil to the market.
So why is this one country's oil such a big deal? Well, it all comes down to chemistry and geography. See, both Canada and Venezuela produce a similar type of heavy crude oil, and that specific kind of oil needs special refineries to process it, and most of those refineries are in one spot, the U.S. Gulf Coast. So suddenly, they become direct competitors fighting for the exact same customers. And if Venezuela's oil, which might be cheaper to produce, floods the market, well, that could spell trouble for Canada. One market watcher on Reddit really didn't mince words, saying the losers will be anyone operating in the oil sands of Alberta. It's blunt, but it highlights the very real economic threat. More supply fighting for the same customers usually pushes prices down. And you can see the domino effect right here. This new competition could mean Canadian companies have to sell their oil at a bigger discount. That hits their profits directly, which, you guessed it, puts those dividends we talked about at risk. It just creates this big cloud of uncertainty over a really key part of the TSX. So this example of a real-world risk brings us to our final section, and really, the core strategic question every single investor needs to answer for themselves.
And it all comes down to understanding the difference between these two things. Dividend yield is the cash in your pocket right now. But total return, that's the whole story. It's the dividend plus what happened to the stock's price. Because think about it, a stock with a high yield that loses value could still mean you lost money overall. You've got to look at both.
So what do you do with all this? It really boils down to a pretty simple 3-step framework for yourself. First, be honest. What is your main goal? Is it cash today or a bigger nest egg tomorrow? Second, make sure you're looking at both the yield and the total return. And third, always, kick the tires and assess the risks. Is that income stream really sustainable? And as you're thinking about managing all those risks, this line from JP Morgan is just a fantastic reminder. Spreading your bets around isn't an outdated idea. It's still absolutely critical. It's not about trying to avoid all risk, that's impossible. It's about managing it smartly.
Which leaves us with this last question, and it's one only you can answer. Looking ahead to 2026, when you think about your own financial goals, what's more important, the income you can generate today or the growth you can build for tomorrow? Knowing your answer to that is the real key to making your money work for you.